The eurodollar market is massive. It's $10 to $13 trillion. The problem with the eurodollar market is not buying T-bills. So what the United States wants to do is get them lending to the government. How do they do that? Stable coins. I'm telling you guys, Bitcoin and stable coins are the liquidity sponge. They're the best expression of currency debasement. They're going to soak up all the printing. They're going to soak up all the liquidity. Bitcoin's going to 250 to a million this cycle. That is still my prediction. Bitcoin will go to the moon. Guys, I cannot even begin to explain to you. If they inject all this liquidity, they send rates to zero, and we go through, we're on the brink of a sovereign debt crisis in the United States of America, and they need growth. So growth is another way of they're going to bet on the economy, which is another way of they're going to print a bunch of money.
The stage is being set for one of the wildest shifts global finance has ever seen. Imagine trillions of dollars, yes, trillions, circulating outside the US banking system, sitting in eurodollars that can't easily move into safe havens like treasury bills. That money isn't just idle, it's desperate for a channel, and Washington's quiet solution is to funnel it into stablecoins. If that happens, crypto stops being a speculative corner of the market and becomes the liquidity sink for the world's excess cash. Pair that with the Federal Reserve pivoting to rate cuts, and the setup for risk assets is explosive. Jack Mallers put it plainly, the numbers are staggering. Somewhere between $10 and $13 trillion in eurodollars are floating in search of yield, and stablecoins are the bridge that lets them flow back into circulation. Once that current starts, Bitcoin becomes the ultimate beneficiary. Stablecoins provide the rails, but Bitcoin captures the narrative and the upside. This is how you get price targets that sound insane until they don't. $250,000? Possible. $1 million? Not out of the question. When trillions of sideline dollars collide with the hardest asset ever created, the result isn't a rally, it's liftoff. Bitcoin's next cycle won't just be big, it could be generational. Let's bring you more clips from Jack Mallers' sharp market analysis to gain more insight. Please don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the rest of the video.
So this obviously is something we've talked about a lot, is that stable coins are now strategically valuable to the United States of America. There is no ifs, ands, or buts about it. We speak facts here on this show, especially after the Genius Act. What have we been talking about? We say stable coins are the ace in the hand for the United States. They're a way to get marginal lenders to the country because every single stablecoin minted is a U.S. Treasury buyer. They are T-bill purchasers. So if you want more lenders to the U.S., grow stablecoins. What's the best way to grow stablecoins is to grow Bitcoin, and vice versa. When stablecoins grow, Bitcoin grows. When Bitcoin grows, stablecoins grow. They are the most liquid trading pair in the future world reserve currency. Period. This idea is starting to pick up steam, and so much so that I want to highlight an article written by Arthur Hayes. And I zoom in here. Here's what he thinks we'll see. The need for oversight of the offshore USD market, aka Eurodollars. So the prediction is this. If the US is going to use stablecoins and Bitcoin as a liquidity sponge, as a way to find marginal lenders to the United States, which we've been talking about, and I know I sound crazy, guys, but I promise you I'm not. First, we'll see that they need oversight over the offshore market. Right now, there is no oversight. You'll start to see some headlines. Trump talks about needing oversight over offshore market for national security, blah, 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 blah. Next, tying the use of central bank dollar swap lines with the Fed and or Treasury to opening up certain aspects of digital markets to U.S. tech firms. Next, regulations put forward to require stablecoin issuers to hold dollars in a U.S. bank branch and or T-bills. Encouragement of stablecoin issuers to list on the U.S. stock market. We saw Circle do that. U.S. big tech firms adding crypto wallets to their social media apps. We've seen Stripe. We've seen SoFi. We're starting to see big tech integrate stable coins. Keep an eye on this. General positive statements by members of the Trump administration about stablecoins. Okay, so I encourage you guys to read the full article. Sorry I had to read through that, but it's really important. Go big or go home. Buffalo Bill Bessent has a choice. Go big or go Democrat. Does he want Team Red to triumph in the 2026 midterm and, most importantly, the 2028 presidential elections? I believe he does. And if that is the case, The only path to victory is to finance Trump's ability to provide more free shit to the plebs than the Mamdanis and the AOCs of the world. Therefore, Bessent needs to find a price-insensitive buyer of U.S. debt. Obviously, he believes stablecoins are part of the solution given public statements of support for this technology, but he needs to go all the way. If the eurodollars and deposits of the global south and Europeans don't flow into stablecoins, he must Bismarck them with his star-studded member. It puts the dollar on its skin or it gets the sanctions again. 10 to 13 trillion in the eurodollar market, $21 trillion of currency deposits in the global south. That puts a target for stablecoins at around $34 trillion. If we get even a fraction of that, Bitcoin soars. Bitcoin absolutely soars. Now, I'm not just going to pitch you some crazy idea and say, believe me, bro. The point of walking you guys through all of that, and I know it was dense, is to show you that the headlines that Arthur started to predict have already started to come out, okay? We've covered these headlines on the show. So the U.S. would start weaponizing swap lines. Well, this is from the Financial Times. Central banks are beginning to fret about dollar swap lines. This is absolutely real. Trump is doing this. From The Guardian, Trump threatens tariffs on countries that discriminate against U.S. tech. What's the only way that we can get stable coins to proliferate in a way that the U.S. needs them to? Well, if WhatsApp, if Instagram, if all Facebook's products, if Twitter, Elon, if these guys who already have hundreds of millions, if not billions users all over the world, if they are, if they implement stablecoins and are able to proliferate and extend into the global south, the U.S. is going to get its way. So Trump says, let these companies do what they want. Do not overregulate them. Do not threaten them, or else you get the big gun. So that is already happening. Politico, Lagarde's Euro moment busted by dollar-linked stablecoins. Current and former PBOC heads disagree on stablecoin hype. So now at the European Central Bank, with the PBOC, the Public Bank of China, there's a massive emergency meetings and threats about stablecoins. Stablecoins are the ace in the U.S. government's hand.
The eurodollar market is overflowing with trillions of dollars, yet much of it struggles to find safe ground in treasuries. Now, the U.S. is eyeing stablecoins as the bridge, tying them to banks, stock markets, and even tech apps. This isn't just regulation, it's a massive liquidity pipeline being built in real time. Stablecoins will carry the flow, but Bitcoin stands to capture the upside. When trillions start moving through digital rails, the next leg up won't just be big, it'll be historic.
So my personal opinion is the United States is going to continue to rely on stablecoins to be the marginal lender. Stablecoins inherently are good for Bitcoin. Bitcoin's inherently good for stablecoins. It's this idea that you have the only free market in the world that is a liquidity sponge. Okay, liquidity sponge. Stablecoin is the inevitable on-ramp to Bitcoin for billions of people not in the United States. That is my official opinion. I am sticking to it. I think so far we have been correct, and we will see how it plays out. But I highly encourage you read this article and the strategy that the U.S. has slowly but surely positioned itself, threatening the eurodollar market, threatening swap lines, pushing stablecoins, regulating it. I really genuinely think that this is going to become more of a story as time goes on. Let's keep an eye on this. This post from Mel, very, very good. Without lower rates across the curve, the fiscal path for the U.S. is dire. With lower rates, it is not ideal, but manageable. The question is, can we do it without blowing up inflation? MMT would suggest we can. I think one way or another, we're going to find out. It's a monetary gamble, perhaps a desperate one, but I think that not only the US and the Fed, but eventually the ECB and other major central banks around the world are going to join in on this global experiment of lower for longer, despite inflation staying above 2%. They will pin their hopes on a cocktail of MMT plus AI deflationary forces. Case in point, in 2008, interest expense as a percent of GDP was only 1.7%. In 2020, it was 1.6%, a slight decline. Yet debt to GDP increased from 64% to over 130% in that same period. In 2021, interest expense was down 1.49% of GDP and then doubled to roughly 3%. There's only one way to bring interest expense down as a percent of GDP, less debt or lower rates. So let me just break this down for you guys. What Mel's talking about here, the long and short of it is we drastically increased our debt. So the green line here is the debt, okay? The blue is federal outlay, so it's interest as percent of GDP. And his point is we drastically increased in the circled part here from 2008 to COVID. We drastically increased the debt, but we were able to kind of hide it because we had such low interest rates. So obviously, if you're paying 0% on debt, who cares? It's not expensive. It's free money. But all of a sudden, when we had to hike rates as fast as we did because of inflation, then banks started to fail and, we're in the mess we're in now. All of a sudden, this becomes very prominent. And you've racked up so much debt that now you have to pay real interest expense on, and it becomes unaffordable. And so his point is you either have to reduce the debt drastically and stop spending, or you have to lower the rates. And we all know what they're going to do. They're going to lower the rate.
The US is learning to lean on stablecoins, not as a side experiment, but as a lifeline for a dollar system that can't absorb its own overflow. Stablecoins thrive because they orbit Bitcoin's gravity, while Bitcoin grows stronger with every dollar that flows through them. One is the vessel, the other the anchor. Together, they form a feedback loop that blurs the line between fiat liquidity and digital scarcity.
This is the largest outlay, so the largest expenses for the U.S. government. So treat this as, we're managing the expenses for the U.S. You have health and human services. Over here is our biggest expense, Social Security. Here's our Treasury expense, okay, third. Then you've got defense, and you can see green is 2025, blue is 2024, and pretty much every green bar outside of education is higher than blue, which means as time goes on, we have to keep spending. That's the problem we're all in. The debt has to grow. And so when you look at this and you think, well, how can we get the spending down? How can we get the debt down? Because to Mel's point, we have to either get the green to come back down to earth or the blue has to come back down. And one is easier than the other. Getting the green down is let's spend less on health and human services, take away everyone's Social Security, don't spend on defense. And I'm talking about cutting these things by like 20, 30, 40, 50%. Or you can send rates close to zero. Sending rates close to zero just takes this blue line and shoots it right back down to where you have all this debt, but you're not really having to pay much interest. Does that make sense? And so obviously when you look at these expenses, what's the biggest one that you can actually eliminate? It's Treasury. It's the interest on the debt. It's the interest on the debt. And so when you see things like the United States, like Trump says he'll have a Fed majority soon to push rates lower after firing Cook. Trump team weighing options to extend influence to Fed banks. Guys, make no mistake. Now did these people break the law? Should the Fed be audited? Like, listen, whether or not they broke the law, whether or not the Fed should be audited, this, that, and the third. The reality is, the United States has to lower the rates. It's math, okay? So make no mistake that all of these efforts, firing people, wanting to audit the Fed, getting in Jerome Powell's head, it's because the U.S. government is at a tipping point. We have a sovereign debt crisis on our hands. We either have to stop spending immediately or the rates have to go towards zero. It is math, okay? And so when you hear Bessent say things like this, let me play it.
And that they shouldn't be serving as one of the nation's leading financial regulators. And what we haven't heard from Ms. Cook is we haven't heard her say, I didn't do it. We haven't heard her say, I didn't do it. She just keeps saying the president can't remove her. The other thing, too, that I have called in the recent past for an internal review of all the Fed's operations, and I've encouraged Chair Powell to do this on an internal basis before there is an external review. And this is the kind of thing that needs to be addressed because the Fed is an unaccountable institution, and its relationship with the American people depends on a high level of trust. And incidents like this puncture that trust.
So I hope that you guys can just understand what's happening. Should the Fed be audited? Yes. Am I a fan of the Fed? No. Do I think all central banks should die? Yes. But what's happening, make no mistake, the US government is in a crisis. It is fiscal dominance or die. Send the rates lower or we all lose. Guys, I don't know how to convey the severity of what's happening.
Interest rates are the lifeblood of the U.S. government's financial machinery. Higher rates mean Washington pays more to service its towering debt, leaving fewer options, but to issue even more treasuries to keep the system afloat. It's a cycle that quickly becomes unsustainable, especially when trillions in offshore dollars hesitate to buy those bonds. When rates fall, the dollar weakens, liquidity expands, and risk assets surge. Near-zero rates turn savings accounts into dead weight, pushing capital to seek scarce, high-upside assets. Bitcoin, with its fixed supply and global reach, becomes the natural escape valve. Every cut the Fed makes doesn't just ease Washington's burden, it fuels Bitcoin's momentum. The lower the rates go, the higher Bitcoin's trajectory becomes. Let's watch more clips from his interview.
I wrote a tweet thread. Look at the date here at the very bottom. This is March 2023 when I wrote this. It was a decently popular one. This was right after all of the, this was Silicon Valley Bank, and this was before even we knew that they were going to get bailed out. The point of my tweet thread was exactly what I wrote. We're watching the banking system of the United States collapse on itself in real time. Okay, the Federal Reserve may have broken the U.S. banking system. And I go on to say that gold and Bitcoin are going to be critically important. What I want to highlight is at the end of the thread, the very last tweet, it's like 20 tweets long. And I explain, why hiking rates basically collapsed the U.S. banking system, but why they had to hike the rates and blah, 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 blah. The very last tweet, I say, keep an ear out for any narrative change from the Fed and/or the media around their 2% inflation target. They'll try to normalize this new era of persistent inflation and ease the market into it. The recent gold and Bitcoin moves are no accident. This was on April 11th, 2020. And now what we're seeing from the US government is an effective takeover of the Fed, destroying any sense of independence they've ever had. And what else are we seeing? A change of the target. Powell said the Fed has adopted a new framework that removes a reference to the central bank seeking inflation that averages 2% over time, and that one is making decisions on employment based on shortfalls from its. So we are here, guys. This has been a long time in the making. I wrote that thread years ago saying inflation is the new normal. And as Mel wrote in his tweet that I read, this one, it's not just going to be the US. The US and the Fed, but eventually the ECB and other major central banks around the world are going to join in the global experiment of lower for longer despite inflation staying stubbornly above 2%. And the risk he's talking about is, can stuff like AI magically grow our way out? But even as we've talked, I don't think it's going to be that simple, because AI is going to disrupt a lot of stuff. There's going to be a lot of white collar that needs blue collar jobs. It's going to be very, very different. So we are in a fiscal dominant state that is once in a lifetime. This was today, guys. This was hours before I hit record. I snuck this in. Besant, we may declare national housing emergency in the fall. Guys, it is Labor Day. People are barbecuing on a holiday. The Treasury Secretary of the United States, the CFO of the US government, decided to hit the press wire and say, we may declare a national housing emergency in the fall. And what's my take on that? This is what I wrote to make sure that I conveyed my take accurately. Here's the political wrapper. Besant just said Trump may declare a national housing emergency this fall. Why? Because boomers need an exit, and the only way to create that liquidity is to lower rates across the curve. So this is their political scapegoat. Housing crisis caused by the Democrats, but make no mistake, they are sending rates as close to zero as they possibly can. They will then use stablecoins with those near zero rates to have an unbounded lender to the United States government. And they are going to focus on markets like real estate. Bitcoin will be the liquidity sponge. Bitcoin will go to the moon.
Meanwhile, Bitcoin's rejection at $113,000 came as markets braced for a Fed rate cut after weak job numbers and rising unemployment pushed expectations to new highs. For the U.S. government, high rates have become a burden, inflating debt servicing costs and straining Treasury demand. Cutting rates isn't about choice anymore. It's about survival. But every move lower carries consequences. Cheap money floods markets, weakens the dollar, and drives capital into scarce assets. Gold is already breaking records above $3,600, and Bitcoin is primed to follow. Jack Mallers has argued that stablecoins will act as the rails for trillions of offshore dollars, but the real destination is Bitcoin. Stablecoins provide the liquidity bridge, while Bitcoin captures the upside as the hardest settlement asset. Short-term ETF outflows or dips below resistance are just noise. The deeper truth is simple. When rates fall, Bitcoin doesn't just climb. It accelerates toward generational highs. As we wrap up, do you think stablecoins really strengthen Bitcoin, or are they a hidden threat? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to subscribe.